Hey, everyone. Today, we're diving into a crucial concept in the world of investing, margin of safety. Imagine this. You're buying a car. You wouldn't just pay the asking price without checking its condition, history, or comparing it with similar models, right? That's essentially what margin of safety is all about in investing. It's about buying a stock at a price significantly lower than its intrinsic value, its true worth. This difference between the market price and the intrinsic value, that's your margin of safety. Think of it as a buffer, a cushion against potential losses. Because let's face it, the market can be unpredictable. By having that margin of safety, even if your analysis is slightly off, you're still protected from significant downsides. It's like having a safety net while walking a tightrope. It doesn't guarantee you won't stumble, but it sure helps if you do. Now you might be asking, why is margin of safety so important? Well, let me tell you, it's the cornerstone of successful investing. It's the principle that helps you sleep soundly at night, knowing your investments are built on a solid foundation. Here's the thing, the stock market is a dynamic beast. Prices fluctuate, sometimes wildly, influenced by a myriad of factors. Emotions run high, and fear and greed often cloud judgment. This is where margin of safety swoops in like a superhero. It acts as a shield against these market swings, protecting your portfolio from the inevitable ups and downs. By buying stocks at a discount, you're essentially buying $1 for 80 cents. This approach not only minimizes your risk, but also enhances your potential returns. Remember, in investing, it's not just about how much you make, but also about how much you keep. Don't just take my word for it. The power of margin of safety has been proven time and again by some of the most successful investors in history. Legends like Warren Buffett and Seth Klarman have built their fortunes on this very principle. Take Warren Buffett, for example. He's known for his incredible track record of identifying undervalued companies and buying them with a significant margin of safety. His investment in Coca-Cola in the late 1980s is a classic example. Buffett recognized the intrinsic value of Coca-Cola's brand, global reach, and strong financials. He bought the stock at a price that provided a comfortable margin of safety, and the rest, as they say, is history. Another successful investor, Mohnish Pabrai, credits margin of safety as the key to his remarkable returns. He once said, "Heads, I win. Tails, I don't lose much." That's the beauty of margin of safety. It skews the odds in your favor. Now I know what you're thinking. This all sounds great, Graham, but how do I actually calculate margin of safety? Well, it's not as complicated as you might think. Essentially, it involves determining the intrinsic value of a company and then comparing it to its current market price. There are various methods to calculate intrinsic value, but a simple one is the discounted cash flow, or DCF, analysis. This method involves projecting a company's future cash flows and then discounting them back to their present value. The resulting figure represents the intrinsic value of the company. Once you have the intrinsic value, subtract the current market price from it and divide the result by the intrinsic value. This gives you your margin of safety. For example, if you calculate a company's intrinsic value to be $100 per share and it's currently trading at $70, your margin of safety would be 30%. Section 5. Case Study, Warren Buffett and Coca-Cola. Let's delve deeper into Warren Buffett's investment in Coca-Cola to illustrate the margin of safety in action. In the late 1980s, Coca-Cola was facing some challenges, and its stock price had taken a hit. However, Buffett saw through the temporary setbacks. He recognized the enduring strength of Coca-Cola's brand, its global distribution network, and its incredible potential for growth, especially in emerging markets. He estimated Coca-Cola's intrinsic value to be significantly higher than its market price at the time. This discrepancy provided him with a comfortable margin of safety, allowing him to invest with confidence, even amidst market uncertainty. Buffett's investment in Coca-Cola turned out to be one of his most successful. The stock price soared in the years that followed, generating substantial returns for Berkshire Hathaway, his investment firm. This case study highlights the importance of looking beyond short-term fluctuations and focusing on the long-term fundamentals of a business. It also underscores the power of margin of safety in mitigating risk and enhancing returns. Section 6. Case Study, Mohnish Pabrai and Fiat Chrysler. Another compelling case study is Mohnish Pabrai's investment in Fiat Chrysler in 2012. At the time, Fiat Chrysler was considered a risky bet. The company was struggling financially, and its stock price was languishing. However, Pabrai saw an opportunity. He believed that the market was undervaluing Fiat Chrysler's potential, particularly its partnership with Ferrari. He calculated the company's intrinsic value to be significantly higher than its market price. This discrepancy provided him with a substantial margin of safety. He invested heavily in Fiat Chrysler, and his bet paid off handsomely. The stock price more than quadrupled in the following years, generating exceptional returns for Pabrai's investment firm. Pabrai's investment in Fiat Chrysler demonstrates that margin of safety can be particularly effective in situations where the market is overly pessimistic. By focusing on the underlying value of a business and demanding a significant margin of safety, investors can capitalize on such opportunities. Section 7. Beyond the numbers, qualitative factors in margin of safety. While quantitative factors like financials and valuation metrics are crucial in determining margin of safety, qualitative aspects are equally important. These include the quality of management, the company's competitive advantage, and the industry's long-term prospects. A company with a strong management team, a durable competitive advantage, and a favorable industry outlook is more likely to weather storms and deliver long-term value to its shareholders. These qualitative factors contribute to a higher intrinsic value and consequently, a wider margin of safety. For example, imagine a company with a patented technology that gives it a significant edge in a rapidly growing market. Such a company would warrant a higher margin of safety than a company operating in a declining industry with fierce competition. Therefore, when assessing margin of safety, it's essential to consider both quantitative and qualitative factors. A holistic approach provides a more accurate picture of a company's true worth and its potential for future growth. Section 8. The importance of patience in value investing. Investing with a margin of safety often requires patience. The market may not always recognize the true value of a company immediately. It may take time for the market price to converge with the intrinsic value. This is where patience comes in. Value investors, like Warren Buffett and Mohnish Pabrai, are known for their long-term perspective. They're not fazed by short-term fluctuations and are willing to wait for their investment thesis to play out. Remember, investing is a marathon, not a sprint. By being patient and disciplined, investors can ride out market volatility and achieve their financial goals. Margin of safety provides the peace of mind to stay the course, even when the market gets choppy. Section 9. Margin of safety, your shield against market volatility. The stock market is inherently volatile. Prices can swing wildly in the short term, driven by news, sentiment, and speculation. This volatility can be unnerving for investors, especially beginners. However, margin of safety acts as a buffer against these market swings. By buying stocks at a discount, investors are essentially building in a cushion to absorb potential losses. This cushion provides peace of mind and allows investors to ride out market storms without panicking. Think of it this way: if you buy a house at a 20% discount, you're less likely to lose money if the housing market experiences a downturn. The same principle applies to stocks. Margin of safety provides a margin for error, protecting your portfolio from the inevitable ups and downs of the market. Section 10. Common mistakes to avoid when applying margin of safety. While margin of safety is a powerful concept, it's not foolproof. Investors can make mistakes when applying it, which can undermine their returns. Here are some common mistakes to avoid. Overestimating your ability to value a company. Valuing a company is not an exact science. It involves making assumptions about the future, which can be unpredictable. Be conservative in your projections and factor in a margin for error, confusing price with value. Just because a stock is cheap doesn't mean it's a bargain. A low price can sometimes be a reflection of fundamental problems within a company. Focus on the intrinsic value of a business, not just its stock price. Ignoring qualitative factors. As mentioned earlier, qualitative factors like management quality and competitive advantage are crucial in determining margin of safety. Don't just rely on numbers, consider the bigger picture. Being impatient. Value investing requires patience. The market may not always recognize the true value of a company immediately. Be willing to wait for your investment thesis to play out. Section 11. Embrace the margin. Invest with confidence. Margin of safety is more than just a financial concept. It's a mindset, a way of approaching investing with prudence and discipline. By embracing margin of safety, investors can make more informed decisions, manage risk effectively, and achieve their financial goals with greater confidence. Remember, investing is not about getting every call right. It's about making smart decisions that tilt the odds in your favor over the long term. Margin of safety is the key to doing just that. So embrace the margin, invest with confidence, and watch your portfolio grow steadily over time.